So let's see here. I think we're live on Facebook and YouTube, and trying to see if we're going to go live here on Instagram. We should be live on Instagram. Let's see. Maybe we'll get the Instagram feed figured out here in just a second. But good evening, ladies and gentlemen. Welcome to the Rates and Lanes podcast. I am your host, Rico Muhammad. I am going to be joined shortly by my co-host, Mr. Chuck Snow. And tonight, our special guest joining us again is Mr. Dean Croke from DAT. It is this is a really good show that we're going to have. So we're actually live tonight. So if you guys have questions and comments, you can actually send those in and we'll get to them right there on the fly. If you find any of the things that we speak about and talk about tonight entertaining, or you can find it useful at all, or you know someone else that might benefit from this information, by all means, share the show with them. But like, share, and subscribe. It helps us out hugely and tremendously. Doesn't cost you a thing, and we promise we won't spam your email box or nothing like that. We just want to try to make sure that you are notified whenever we do get a chance to go live and that you can be a part of the show. And with that being said, without any further ado, let me welcome my co-host, Mr. Chuck Snow. Good evening, Chuck. How are you?
Oh, you know what? We're doing well, Rico. It's winter up in Canada, and it's starting to get cold.
Yes, indeed. I believe that's kind of the prognosis all across the country. It's starting. Last week it wasn't too bad, but I'll tell you what, this week the old man winter has definitely visited us and it made a return.
Yes, and Farmer's Almanac was right for a change.
Yes, indeed. Yes, indeed. Well, I'll tell you what, this is the first time that we have, since the election, that we have had our good friend Dean Croke back on. And so I don't want to belabor the point. I want to welcome Dean into the show. And as a matter of fact, let me move him to the top of the pile there. Let me see if I can see if we can move him. There he is. We're gonna put him up at the top.
Hi, Dean.
Good evening.
So Dean, right before the election took place, a couple of different outlets. I don't know if DAT put anything out, but I think a couple of different outlets with different landlines. It may not even been landline. I don't even want to attribute it to nobody. I just seen a couple of different publications that saying that the Great Freight Recession was coming to an end. This was right before the election took place, and then immediately after the election took place, I did notice something quite peculiar. When I was posting on the spot market for the first time in a long time, my phone actually started ringing from brokers calling. Right. And normally you would have to be the one doing the chasing to go chasing.
Did you know what the sound was? That's what I want to know.
Say that again, Chuck.
When the phone rang, did you know what that sound was?
Oh, I was elated. I was like, it blew me away. The first couple of times, I was like, wait a minute. And then when it started to ring on a consistent basis, I was like, oh, this is good. This is good.
What's that noise?
This is what this is what, when I was working the spot market heavy, this is what I was more accustomed to and more familiar with. The times of having to actually go chase the freight, so to speak. I wasn't so familiar with that aspect.
Yeah.
How soon we forget.
You know, Rico, a couple of things happened, right? So we still had a lot of capacity leaving the market over the course of the year. That's still ongoing. The reason why I think you're seeing a bit more activity, I went back and looked at our load post volumes, and they are about 14% higher than the same time last year. So you're seeing more load posts, which is a proxy for brokers looking for carriers.
Right.
So the higher the load post number goes, it means brokers are posting more loads, and sometimes the same load multiple times to get to more carriers. So that's why the load to truck ratio is sort of an important indicator. The other thing that's happened is when you look at so load posts are one factor, loads moved is the other factor, which is they're the loads that get moved from the load post. So it may be a 2-to-1 ratio or whatever it is.
Yeah.
The volume of loads actually moving physically on trucks is up about 7% compared to last year. So we're moving more freight with fewer trucks than we had last year. So more loads, fewer trucks, more activity in the spot market. Rates are steadily going up. Rates are about 10 cents a mile higher than if we were talking this time last year. That's excluding fuel, right? So there's a couple of, and since we're on the show, the market has bottomed out and is starting to come back up again in the spot market. So that's a definite. When we last met, it was a trend that we were hoping would happen. It's happening, but I don't know if it's going to be short-lived or not. So I have to caution everybody in thinking that just because we've had an election and suddenly everything's going to come right again, it's going to take 6 months before that happens. And I say that with a couple of things in mind. One is we've got a strike that's now got a higher than 50% probability of happening on January 20, right, with the Gulf Coast and East Coast longshoremen. That means that we're going to see probably a record number of import containers come in December to get ahead of that. Now, warehouses are already chock full of inventory already. So importers have been bringing in lots and lots of containers to get ahead of a Trump presidency and tariffs and trade wars. They've already been planning for this as a contingency. They already bought more inventory in because of extra transit time around the Red Sea crisis, to run another 12 days in transit time. They already bought a lot more inventory in this year because of the strike that occurred, the 3-day strike by the Gulf and East Coast port workers. So because we built so many warehouses during the pandemic, there were a lot of warehouses sitting empty. So importers have filled up warehouses to the brim, and they are ready for whatever may come. Now, that doesn't mean that there won't be a scramble to bring in imports. But there's 2 points I want to make, and I'll pause. One is that we are bringing forward next year's import volume into this year. So what would normally come in Q1 is coming in Q4. So we're robbing from one quarter into another quarter. So, Rico, you're seeing more activity and brokers calling you, less trucks and a little bit more volume. So I would caution people in not thinking that just because we've got a little bit more volume that's sustainable, because I think we're pulling forward some of next year's volume now, just like we did in 2018 when the first round of Trump tariffs came in, and then we had a freight recession in 2019. And the tariffs, so the trade war was part of that decline in 2019. So that's sort of what you think. And the other reason I'm sort of cautious about things is I think there's just a big pause. A lot of people are going to hit the pause button now and say, let's wait and see what campaign rhetoric turns into in terms of policy. You've already heard Chairman Powell talk about interest rates. We may get a 25 basis points cut in the next meeting, but there's a strong chance that if a trade war happens and we impose tariffs on Mexico and Canada and China, that has an inflationary impact. We are already had enough of higher prices. So I think people are going to buy less. If prices go up, people will buy less. Interest rates will go up. People will invest less. So I think until people figure out what's going to happen, there'll be a lull in the first half of next year before we see things really turn around. Now, the flip side of that is if we get tax cuts immediately, like tax cuts take a time to come through, right? Corporate tax cuts, the continuation of the Trump presidency tax cuts, that takes time. But remember, in 2018, tax cuts were a big part of why that was such a great trucking economy.
Yes. Tremendously interesting, Dean. If you would entertain me just for a second, I would like to if we're talking about the tariffs and things of that nature, can we maybe break it down by segment? But what I mean by segment is flatbed, refrigerated, and dry van, to kind of, if we could go segment by segment and try to figure out where do we see. I know you said that Q1 is kind of taking place right now in conjunction with Q4.
Right.
Which segment is going to be having most of an impact on?
So initially dry van, right? Because dry van is probably the most connected to containerized import volumes,
Right.
And then secondary flatbed. I think refrigerated gets a little bit of a pass here early on, other than a tit-for-tat trade war means we'll sell less pork to overseas countries out of Oakland and San Francisco ports, out of the Midwest.
And
right?
other products too, like canola and all that stuff.
Right. So soybeans, Canada gets hit really hard with exports. So don't forget that a trade war means if we impose tariffs on China, they impose tariffs on us, and then next thing you know, you've got lower volume all around. So I think dry van gets hit initially, Rico, because a lot of your primary and secondary inputs into domestic manufacturing travel in dry vans. Especially you've got international containers come in, they go on an intermodal train, a dray truck picks it up, or it gets transloaded in Savannah or Ontario, California, and gets put into a 53-foot van. So I think dry vans in particular, and then I think flatbed, because it hauls most of the industrial economy on its back. And I think that's where you'll see some trade-off. So now, just for everybody listening, I'm talking nationally.
Right.
It's very different regionally. So, regionally, because there's so many imports coming into California right now, the truckload volume in California is up compared to last year. It's up. Outbound line haul rates in Ontario are 13% higher than last year, and the volume of loads moving are 25% higher than last year. And that's simply because Ontario and Los Angeles account for about 65% of California's outbound truckload volume. Why is that? Import container volumes are up 28% in Los Angeles. So to my point that we're robbing some volume from next year and dropping it into this year, rates are 13% higher outbound in California. So if you're in the West, California is a great market to be in right now because there is more volume and more demand. And where we started the show talking about a high probability of a January 15 strike, which is, 3 days before Inauguration Day, when most likely the president will introduce Taft-Hartley and force everyone back to work, it'll still be a 3-day strike. So I think to answer your question, I think we're going to see flatbed impacted on another front, not just because imports are going to be hit and we could have a trade war, but it took time for the changes in the tax code in the Trump presidency to flow into the industrial economy and drive flatbed demand. So you've already got higher interest rates sort of putting a lid on single-family housing construction. I mean, the numbers aren't terrible, but they're not great. Right. So you've still got interest rates playing a role there. We're already seeing the volume of commercial construction slow down, as a result of all the warehouses that were built. But there are some bright spots. Data centers, because of the AI-powered technology, data center spending is running at a clip of about $30 billion a year. It's up it's up 37% compared to last year. So, data centers are massive factories full of computers and cooling systems. Chuck, Rico, these things are massive, and if you go out on the highways, you see these RGNs and drop decks with those big white plastic data centers. There's a lot of freight moving in certain sectors. Some sectors are up, some sectors are down. So when I talk nationally, it doesn't mean the whole market's depressed. Right. Because if you go to the southeast of the country, like in the southeast, we're at the bottom of the freight market in the southeast in terms of rates. But the freight market in the southeast starts to go on a tear now all the way through to May. Every single year, the southeast rates start to bottom out now, and then they climb all the way through May. So again, when you look at averages, rates are pretty flat, And I don't think we may get 5 to 6% increase in rates. We may get, if we're at $2 a mile now, including fuel, we may end up at 210 by this time next year. But I think that, what my forecast is showing is, because of all of the stuff we've just talked about, right, there's still no major catalyst to trigger the economy in North America, especially with this big cloud of trade war hanging over, Canada, Mexico, the US. The first 6 months, I see rates going down like they did last year, and then they gradually pick back up in the second half. The net over the year is rates pretty flat to maybe up. Now, if enough capacity exits, and I think that's a probability, then we could see the pendulum shift. But I think, Rico, that's going to take another 6 months before people really start to make solid investment decisions around their businesses, because they're really waiting to see what the new administration is going to do.
You're reading my mail, Dean. I was going to ask you, how are we looking on as far as outgoing capacity, as far as outgoing carriers that are folding up shop?
Yeah, I looked at the revocation data today. So these are the number of carrier authorities that revoked their authority. Remember, only about 5% of total carriers each month change their operating status. So 95% of carriers, just like you, don't change their operating status. But it's this 5% that really comes and goes every month. Last month, we lost another 7,000. The month before, it was 6,500. It's averaged 7,000 a month, Rico. And we're still losing carriers at that clip, but there's still, for every 10 that leave, 8 come in, right? So we're still, the leakage is very slow.
Right.
So it's not a normal market cycle. And I went back and looked at the number of carriers. So just for those listening, I know you're going to be saying and thinking, well, how many of those carrier authorities are fraudulent? And the answer is we don't know, right? So there's a lot of authorities out there where, not a lot, there are authorities out there where people are masquerading as carriers and they aren't really carriers.
Dean, how many would that be? Maybe 20% maximum?
I don't even think that much. I doubt it's that high. I think it's single digits, Chuck.
Okay. Well, then, then it's not an issue.
Well, it's not an issue. And I say that because when you look at, I've studied this data way back to 2014. So there's a decade worth of data here where all this has been going on, and the trend is pretty clear. So I don't focus on the numbers specifically. The direction of the trend line is very important, and it maps to another data point we can talk about, which is the truckload carriers, the big mega carriers, what their truck counts are doing. So to answer your question, Rico, yeah, we're still losing carriers. There's still an exodus of carriers underway. The net is for those that leave and those that join, we're still losing capacity. Hence, you're getting phone calls, right? Because there is the capacity is tightening.
Right.
I don't think it's over yet, though. I think when I looked at the numbers, we've had 483,000 carriers join since June of 2020.
Wow.
And we've had something like 380,000 leave. So by my math, and this is fairly rough back of the envelope,
got a surplus.
18% of the carriers that joined during the pandemic are still here. And that's why when people talk about how long this market has taken to turn and how many carriers there are in the market and why rates have been so low for so long, it's because we had so many carriers hanging in there trying to make ends meet. Now, they are gradually leaving the industry. 12/31 is a common renewal date for insurance contracts. Right. I expect another exodus of carriers at the end of the year. I think there's another tranche of carriers that sort of say, let's ride out the busy season and then we'll make a decision on 12/31 about what we do. Normally, we see a surge in exits on the carrier authorities on 12/31 or in January every year. So I don't think next January will be any different. So if you sort of pull back the lens, we've got capacity decreasing. But so if you think about, yeah, we've had a lot of carriers leave, but those carriers that are here ran 6% more miles this year, offsetting that. Right. So when you run more miles, you add more capacity. So those that left ran more miles, added capacity, and then those that weren't making money got out. So the net is we've still had this capacity that was able to meet demand. And it never flipped the switch. when you sort of surge around, peak shipping season now, it's a gradual increase in rates. Like we're not seeing the sort of lift that we would normally see.
Right.
So that's the spot market. So think about the spot market. That's 20% of the trucks on the road or loads on the road. The 80% of the loads that are contract, not spot, pre-negotiated rates. The Journal of Commerce has a thing called the Truckload Carrier Index, and what Bill Cassidy does at the end of each quarter, he looks at the average of all of the trucks that the large carriers report on their earnings calls, and he's built an index around it. And it's down to they've been large carriers that are public have been dropping their truck counts for 9 quarters.
Whoa.
Right? And in the third quarter just finished, it flattened out. So what that tells you is the big mega carriers have been cutting back their fleet sizes for the best part of 2 years. They've just slowed it right back down. Now, that means that they think their truck counts are getting close to where load counts are. And you would say, okay, how do we know they're there? Because new rates being negotiated in RFPs are coming in flat to slightly up.
Right.
So remember on the show earlier this year, we talked about new contracts were coming in 12 to 15% lower than the prior year's negotiated contract rate.
Right.
They dropped to low single digits this year. And for the last month, they've been bottoming out around 0% change to maybe 1% higher. So that tells you that shippers see capacity tightening. They see rates going up for the bulk of the industry, and they see replacement rates coming in slightly higher. So that tells us, when we look at all these data points and put them all together, it tells us that we are definitely at the bottom and past the bottom of this trough and slowly coming back out. So then you extend your horizon out to next year and you say, what do we see? I see a big pause button. I see a lot of people waiting to see. I see a lot of volatility. I see a lot of deregulation. So the Republican Trump administration will be very, they'll be in a deregulatory framework. Like they'll want to cut back regulations. So that could boost the trucking industry, could lower our costs. So there's lots of things that could happen that turn
But it could it bring on more carriers, though, the relaxing of regulations?
Well, it could encourage more. I think insurance is going to beat a lot of new entrants, though, Chuck. We're in a tight insurance capacity market. Rising costs have been eating everyone's lunch, especially on the medical side, and how claims are becoming the claims cost. The tail is getting longer because of higher medical costs. So I think whilst used truck prices are sort of decreasing, that new entrant cost, I think, will be cost prohibitive. Now, normally I would have said lower truck prices might have been a thing. I think lower truck prices might be a real thing now, because if the new administration pushes back on the zero electronic vehicle timeline, and I think it was something like 2035, large mega carriers had to have, and I'm going to say 14% of their fleet zero emission vehicles. So if the new administration comes in and pushes back on all of that, it means that our operating costs, in terms of how we think about long-term costs, come down because we're not having to buy as many EVs, electronic vehicles.
Yeah.
Right. So
they're twice the cost of a normal truck, and they're half as efficient, really.
So all of that put together, when you think about the regulations, the emission standards, the slow rolling possibly of EV infrastructure. Right. So if you think about there's a lot of things that could happen. We've talked through all the different possibilities. I just think we really don't know what's going to happen in the next 6 months. We'll hear
great unknown.
And I think that's why people thinking about making serious investment decisions into another production line, another shift, another factory, and right now they're thinking, how do I de-risk myself from China? Yep. Chinese supply chain. How do I shift my business to Canada or Mexico if I haven't already? and many have been already trying to do that. How do we position our trucks? Where do we build our warehouses, our cross-dock facilities, all those sorts of things? A lot of folks don't really know what that's going to look like until we get past, regulation by tweet, or whatever post. So my sense is that we're going to have a pretty choppy first half of next year before we get to a point where there will be some serious economic stimulus. Now, maybe just like in 2018, the industrial economy got a real boost from changes in the corporate tax code, accelerated depreciation. There's some things that could happen that could move the needle, because I don't think capacity leaving is going to move the rate needle, Rico. To get back where you were, it's going to take a demand trigger. Something's got to happen to make more freight for us to haul.
Dean, let me ask you a question. The large carriers, the mega carriers, Hunt, Werner, Schneider, those guys, are they cutting back the size of their fleets as well because of the fact that they can use small carriers probably cheaper than they can use their own trucks?
Well, I think it's a bit of both, right? Because they've been keeping up their leased on owner operator average costs at around $1.70 a mile. Before the pandemic, it was as low as $1.50. So power only has still been a pretty good market for a lot of leased on owner operators. Yeah. They've been reducing fairly aggressively their corporate fleet counts, their own dedicated fleet counts. So I think it's been a bit of both.
You got Schneider that just bought Cowan.
Yep. So mergers and acquisitions is another function of this cycle. Whenever you get to the bottom of this cycle, you see carriers and brokers swallowing up other carriers.
Yeah, because they're bargains.
And
I don't think efficiency. There's great efficiency when you take two carriers like Swift and Knight and you put them together. You're going to save millions and millions of dollars on an operation that size.
Yeah, I think if we don't see some sort of a change in our economy, you could see more mergers and acquisitions. I think I was at a conference a little while ago, and a large carrier said he said we're on the ropes, right? And I thought, wow, what an expression! And I thought that kind of sums up what we've been like for the last 2 years. We've been on the ropes, taking a lot of punches because we've had a lot of excess capacity, a lot of downward pressure on rates. Shippers have been clawing back all of the losses they took for the first 18 months of the pandemic, and some, right? So they know that their rates are bottoming out and that party's kind of over. And they've got to be thinking about next year's rates and tighter capacity. So I just think we're at an inflection point, and in some ways, an election was probably the worst thing we needed to happen. But maybe it's going to turn out to be the best thing that happened because of the opportunity that could come our way if we get some really serious economic stimulus that gives people some hope around, the market. Now, some good news that came out today, the ISM Purchasing Managers Index came out. Sort of kind of been moving sideways. The ISM PMI, it's a diffusion index above 50. It means economy's growing. But there was only one index that showed some serious potential, and that was new orders. So the manufacturing side of the index, the new orders side of it, was pretty good. So that was good news, because that hasn't been something we've been able to write about for a long time, was the PMI there. So ATA tonnage index was up. So again, I think there's lots of economic indicators out there that say we've got a pretty strong end to the year. But and I'll give you an example, right? So we've talked about my operating cost model that I have for small carriers and owner operators. They were in the black for the first time this year at 1 cent per mile gross profit. Now hold on. Diesel went up 5 cents in the last 2 weeks. Now we're back in the red.
That erodes there.
So when you go back and say, well, what does that mean? Well, if I told you that it costs you $1.80 to run a truck, and where rates are today and where diesel is today, your gross profit margin is the same as what it was in 2019 for the average carrier, which was a bad year for carriers. So we're still not out of the woods yet. The name of the game is going to be cost control, speed management, manage your costs. Yeah, exactly. Bruce,
I agree, Bruce.
Bruce took the words out of my mouth. We know you need.
It doesn't work.
If rates are $2 a mile, we know we need $2.40 a mile, right, to make a profit, because 40 cents a mile on 100,000 miles is 4 cents. 40 cents a mile is 40 grand. That's at least what you need for tires and a in-frame rebuild. So, yeah, I'm talking about break even, getting by, paying a wage of 60 grand a year. You're still not making a profit, and that's not sustainable. But that's where carriers have been for most of this year and the last half of last year.
Yeah.
So it's been a grind. We've been on the ropes, and that's why I think a lot of people are looking for answers, and they're looking for a ray of hope that a change in administration will suddenly change things. And I'm just not sure we'll know for the next 6 months what that's going to look like, which makes me think, go right back to where we started. If we're robbing volume from 2025 and dropping in December 2024, the first quarter is going to be rough.
Yeah, robbing Peter to pay Paul.
Because everybody's going to say, well, then we need to wait and see how we go from tweets and campaign rhetoric to policy decisions, and what's executive order, what's cabinet decisions, what's the Congress pass, before we'll really know where we stand. And I think that's going to be the middle of the year before we see it. And I say that with a fair bit of confidence, because we have to have had all of this excess capacity leave the industry by then. Right?
Yeah, that'll really, if we have a bad first quarter, then a lot of the guys that thought they may make it they'll pack it in.
Right. Yeah. So Bruce is right. Tariffs are inflationary. I think exporters get hit the hardest. I mean, we had that happen. We've seen this playbook. We know how exports get hit with tariffs. Automotive's a big part of it. Cross-border.
But even your U.S.-based manufacturers, they're buying so many of their raw goods and raw materials overseas now.
Yeah.
They couldn't possibly source them in America.
We made that decision a long time ago.
You get rubber from Malaysia. That's where it comes from. You don't produce rubber in America in its raw form. You don't grow rubber trees. And all sorts of chemicals that come out of all over Asia. And stuff comes out of Europe. Like, I don't know, these tariffs could really, it could implode on everybody.
Well, if you follow the logic and you say, well, if we apply tariffs and we get the cost passes on the cost of goods to us, and we have to pay more for goods, that doesn't mean people are going to make more.
No.
Right. So I worry about things like your automotive manufacturing plants in Canada, Chuck. The 60 that are there, they've got 120 factories in Mexico.
Yeah,
it's a 2-to-1 ratio. So you've got a lot of cross-border freight that gets caught up in this. I mean, forget the immigration shutting down the border piece and the fact that 73% of Mexican imports come by truck. If you start to mess up with trucks crossing, that's a whole nother problem, notwithstanding the impact on actual freight. So a lot of market volatility. There's a lot of unknowns. There's a lot of uncertainty, but luckily, that diesel prices have been going down. To me, that's the biggest surprise. Well, they went up a few cents in the last couple of weeks.
That's only, diesel is somewhere about a third of our cost.
Right.
Okay. But the other costs, like our wages, I don't think can go down much. Insurance certainly isn't going down. The cost of a new truck isn't going down.
Correct.
The last time I had to buy a tire, that certainly didn't come down. Let's say that facetiously. Nothing up labor. When you take a truck into a dealer, you better be able to put a mortgage on your house. Truck, because it's crazy.
Yeah.
If you need any work done. So I don't know. It's I don't think things are that rosy. Cost-wise.
So Jason Miller did some analysis this week, and he looked at the motor vehicle sector. He thinks motor vehicle automotive is going to be disproportionately impacted by tariffs from Mexico and Canada. So if you look at Mexico and Canada, he did some data analysis on the exact number of imports. There's about $200 billion in imports affected by tariffs on Canada and Mexico. 25% tariff, that puts the cost up to $250 billion. So it goes up $50 billion. Dealer margins have already fallen back to pre-COVID levels. That means dealers won't be in a position to absorb higher costs. That means higher inflation costs for motor vehicles, which could drive down sales as a result. And there are some truckload carriers that are publicly listed that are specialized in automotive parts.
Yeah.
Cross-border. So I think...
And I also heard some news that manufacturer Nissan is in not a little bit, but a whole lot of trouble.
Yeah. Automotive, crude petroleum, electronic computers, heavy duty trucks and chassis are made in Mexico. At the traffic club last week, I've got some quotes from there. A lot of the shippers were, fairly concerned about where things are. They knew that the market was going to turn, but they're worried about industrial production. There was one company there. The company name is... what was this? Companies are thinking twice about spending heavily on capital goods, but there could be some changes. Rockwell was the big company. Rockwell make a lot of controllers in the factory controller, automated controllers and software across a range of industries. The chief executive, Blake Moritz, said, given the uncertainty in the macroeconomic environment and continued project delays across a number of our markets, we're projecting sales growth in the 2 to 4% negative range.
Whoa!
So that's why I talk about the impact of people worried about what's next year's forecast look like, because now they've got a lot of economic uncertainty, and we know that about 70% of our demand for truckload comes from industrial production and manufacturing, domestic, not imports. I mean, imports go into manufacturing, but straight up truckload ton miles, a lot of it comes from domestic manufacturing. So, and of course, Bruce asks a very good question. Do tariff issues affect drivers passing through a country? It's a great question. They certainly on the Mexican side, Bruce, they'll get caught up in delays if the border is shut down. I don't know. I think there's going to be some different industries will get a pass. I think there'll be some pretty heavy lobbying efforts in Washington for carve-outs, where certain sectors get a carve-out, an exemption to certain regulations. That's a strong possibility. Cross-border could be one of it. I mean, don't forget the old NAFTA. What's it called now? The
auto pack.
Yeah, the cross-country, the cross-border. We replaced NAFTA with
FAST.
Yep. So the new administration is talking about rewriting the cross-border trade agreement to include immigration. That's really why we've got my view, and I think some others share that. The reason we've got tariffs being thrown out, it's a negotiating tactic to rewrite the cross-border agreement to bring in some sort of immigration to justify the whole policy platform.
And it got everybody's attention really quickly. Like I don't
know how it works, but anyway, so that's part of the reason you could have tariffs. It may never eventuate. It may just be a bluff. I don't know. So, but I bet it will affect certain industries. But we spend a lot of money between countries. I don't know that would come to pass, Chuck. I could see it happening on China because this is not new news. We've already been a lot of companies have already had a China plus one supply chain strategy already. That's why you're seeing a lot more imports come from Southeast Asia as opposed to Northern Asia, which is China. Yeah. So, you're seeing you're seeing a lot more import volume come into Mexico, right? Yeah. To come up through into the US from there. So there's a lot more import. So if you think about the growth in Mexican manufacturing, it's still pulling imports in from China, raw materials and goods. So China's such a big economy. Like they've been 25 years they've been at this to try and build themselves into the global manufacturing powerhouse they are today. It's going to be hard to change that in a meaningful way. But I think a lot of companies already have built redundancy into their supply chains. They've found a way to try and build redundancy in so they don't have what happened during the pandemic. But then you think about the massive semiconductor chip operation in Phoenix, for example. like some of the grants that have been given by the current administration to encourage development of sustainable renewable technology, right? Solar panels, wind energy, electronic vehicles. If you start to see some of that rolled back, right, that affects truckload volumes. It affects the growth of big centers that build semiconductor chips. That affects guys that haul machinery, that level the ground and dig holes. This is the whole flow-on effect, and that's why I think there's so much uncertainty around what next year is going to look like.
Well, Dean, what's your opinion on electric cars? Now, I know right now it's slowed down a little bit, but if it ever does pick right up and everybody's driving electric cars, my understanding is that your average internal combustion powered automobile has about close to 3,000 different components altogether.
Right.
And an electric car has a couple hundred maximum. And that includes your seats and your windows and everything else. That's a lot less truck traffic.
Good point. Exactly. So if we slow roll some of the adoption of electronic vehicle technology, that would tell us we'll have more freight to haul for fossil fuel powered vehicles. So that there's winners. There's going to be winners and losers in this whole process.
I think there's going to be, with electric, it sounds like there's going to be more losers, because when I drive on the 401, I know who the automotive carriers are, and I see, I would say about 65% of the trailers I'm seeing are hauling automotive around here. Those guys aren't going to be nearly as busy.
No. And if a trade war happens and tariffs are imposed on Canadian imports, then you want to bet that's going to affect those guys in particular that haul a lot of the steel and coil and finished parts back and forward between assembly plants. It was interesting that Musk announced last night that he told his Cybertruck production line people not to turn up to work for 3 days. So who knows what all that means, Chuck, about I'm going to Washington next week. I think I might be seeing a Cybertruck in the Smithsonian next to the Werner 359 or the DeLorean that's there.
Yeah, Bruce just brought up a good point. We had a huge snowstorm about 150 miles north of here in Gravenhurst, Ontario, where they just got lake effect snow that was like, it was the biggest snowfall they've ever had. It snowed for 27 hours straight. And Bruce said, if you were in the Gravenhurst snowstorm for 3 days, you'd be rethinking electric cars. He's 100% right. Or electric trucks, because there were all sorts of guys stuck on the highway. The highway was shut down.
This country's built around travel, right? There's no question. It has been for decades, but not every country is like that. EVs are doing great business in Europe, for example. They have a very different approach to this. And when I say great, I can't quantify that because the numbers don't spring to mind automatically. But this country here is so focused on people traveling. You look at our interstate system, all of the infrastructure at every exit, hotels, restaurants, gas stations. It's an amazing country. It's all built around people driving.
Well, and these are huge countries. You think of how big they are. And we have a different mentality here. I remember I was in the Netherlands with my wife, and her uncle or her cousin was saying to us, well, when my son comes, he has to come quite a distance. He has to come 100 kilometers, which is 62 miles. So he stays overnight.
Right.
And when I told them I take mail across the border, where I go across to buy soda water, and it's about 80 miles each way. And they kind of looked at me like I had 3 heads, like not all in one night, it's just so strange to them because, and they also have great train in Europe, which we don't in North America. And it's sort of town to town.
And you got a lot of barge traffic. I think about 30% of freight moves on barges through the river canal system. Hey, I was just thinking, my wife and I are watching a new series on TV called Landman, starring Billy Bob Thornton. And it's fascinating because it talks about, he does this great speech. It's all based around the oil field out in Midland, Texas, in the Permian Basin. And he has a big speech about exactly this, about how, he was looking at a wind wind turbine, and he went through all the statistics around how much fossil fuel it took to build a wind turbine and how long they last,
Right.
and the cost of all the cranes and the trucks and all of that stuff. But his point was this economy is built around oil, and he said something that was really interesting. He said they had, and of course this is a TV show, but it is based in reality. They had wind turbines there to create electricity for the pumps that suck the gas and oil out, because there's no infrastructure like the Australian outback. And he said if the oil companies thought that wind turbines were the future, they'd be everywhere.
I think it's a great point, and I have to say something else. I've seen them haul those components for these wind turbines, and I have never yet seen an electric truck pulling one of those things, and I don't I ever will.
The fear of, what do they call it, range anxiety. My neighbor just got over his big F1, whatever it is, lightning bolt,
right,
up that's battery powered. Range anxiety beat him after a year. He's, he only works 100 miles. Well, he's got a 100-mile round trip to his office when he goes up there, but it's a real struggle. That's if he can get up and back just okay, but if it's winter and the heater's on and the wipers are on and the lights are on,
he's pushing it.
He has serious range anxiety. So it's a thing. And,
it is a real thing, and it's great for somebody that's commuting a 15-minute drive. But if you start really traveling, good luck. It ain't going to work.
Yeah. Now, having said all that, Los Angeles smog is much better, right? So, I mean, they've done some really good things in terms of cleaning up the air. I think that all of those are good things, but I was struck by talking to a large truckload carrier CEO on a publicly listed company about 2 months ago, and they were talking about why they were so adamant we needed a change in administration. It was largely because of the zero emission vehicle policy, absent infrastructure. He said the cost is burdensome on us to be buying all these electric trucks when there's no infrastructure to charge them.
Yeah,
the economics. So I think that's why a lot of the trucking industry was so anti the EPA regulations that were being rolled out, because they were cost prohibitive. They just didn't make economic sense. So all of that flows downhill. You're going to have less freight to haul. The Inflation Reduction Act, all of those things that came in the Biden administration result in a lot of freight to haul out to, wind farms and solar panel farms. So there's a whole, building boom going on in the western part of this country where it's sunny all the time. They're putting in solar panel plants in everywhere. I counted one the other day just north of Las Vegas. There was 3,000 loads of solar panels from Columbus, Ohio, to just north of Las Vegas for one factory. So for all of our complaining about EV vehicles, it has generated a lot of freight for us to haul. So it takes time for these policies to get wound back.
They're going to only haul. They're going to haul 3,000 loads once. Where these trucks I'm seeing, I know who's driving in front of our laneway here at home, and I know. These guys are running up to the Honda plant and some other plants that are north of here. They'll keep running as long as people keep buying internal combustion powered cars.
Bruce makes a good point. I think, as I said a bit earlier, this country's been built around the motor vehicle and people traveling. Reason why EVs are challenged is the cost of gasoline is predicted to go down, same as diesel, because we are producing a record number of crude oil barrels every day now, 13 million a day, a record number, the highest ever. So the whole notion that suddenly a change in administration means we're going to produce more oil and have more flatbed loads of drill pipe and casing sent out to the Permian Basin or the Bacon or up to the Dakotas, what are we going to do with it? They're already drilling as much oil as they can. They've invested a lot of money in well technology. They're actually producing more oil per well as opposed to just building more wells. So we're already tapped out in terms of production. We've already got a lot of non-OPEC oil hitting the global market, right? So OPEC's going to continue its production cuts to stop flooding the world with excess crude to drive price down because they want to have cuts to keep price under it. So if you just follow the logic here, everything points to lower fuel costs for gasoline costs. So does that mean that people are going to buy more V8 powered pickups? And who knows? But
no, because I think we're past. I honestly think we're into a period of time where the manufacturers are coming up with great vehicles that get better fuel mileage than we ever dreamt of.
Yeah.
30 miles per gallon on a Toyota SUV. I read that's unheard of.
Hybrids. I love hybrids. I think hybrids just make so much economic sense. I was looking at is it BPW that make the axles? There's a company I wrote about a little while ago. A company in one of the big trailer manufacturers in Europe have got a zero emission refrigerated trailer. You'll love this, Rico. Zero emission. The axle that spins has a generator in it, and it's generating power that's stored in a battery that powers the refrigeration motor. And it's a zero emission trailer. Now, of course, there's a weight penalty, but they've also got an engine that produces horsepower to push the truck along, in addition to reduce the load on the truck. So my point is, and then Bruce touched on this, that people are buying a mix of electric, diesel, and other fuels. Someone will come up with something that will work eventually. So through all this trial and error, there could be an LNG, hydrogen fuel cell, there could be EV. We're just on the cusp of this. I think someone will come up with a solution that will be a winning solution at some point. But right now, the economics just don't stack up when you look at the costs of them on the middle mile piece, right? So I think Bruce is touching on final mile, first mile, final mile, short haul, semi-regional. I think that makes a lot of sense, where you can be fast charging while you're unloading and loading on dedicated contract work. But I think the infrastructure to run trucks long distances, that's more problematic. Although there are companies in Europe, the Freightliner Argosy that they've got on the road over there now has got a range of 600 miles at 80,000 pounds.
But does it actually travel 600 miles, or are they charging it at
No, they can get 600 miles out of it before they have to recharge.
Now, but is that in optimal conditions?
Correct. I was just going to say that's probably as good a conditions as you can get on,
like in July,
on pretty good roads, right? So the autobahns around there are pretty good. So again, the range is pretty good. Give that a haircut. We're still, making progress.
Let me put Bruce's question up here one more time. I got a political question to wrap us up.
Bruce, you're full of them tonight. Thank you.
I would put, there's a company here in I think Chuck's frozen, but Rico, you can hear me?
Yes.
Can you hear me, Rico?
I can.
Yeah, that's Andrew Stacey's talking about a company in BC, Edison Motors. That's got. I think that right now they probably have the best invention.
I think we've got an internet problem there. Rico's frozen. Chuck's frozen.
No, I'm here.
He's just cold.
Edison. Yes, Edison. The other thing that there's a company here in Boston that's got a generator that sits on your tail shaft. And as your tail shaft spins, it's creating power, which it's stored in a battery that can run your APU. So your cooling system and your batteries in the truck. So yeah, there's lots of technologies out there that are making a lot of sense for applications that makes sense. Heck, I'd put something in the back of my C15 Caterpillar if I could, to get better than 9 miles per gallon.
So I wouldn't kind of a quasi political question.
Yeah.
Kind of a quasi political question. With the new Secretary of the Department of Transportation, Patrick Duffy, do we know anything about him? Does anybody have any indication on what we might be able to expect?
Well, so I think it's a given that the Trump administration, based on part one was very anti-regulation, no politics, Rico. So I'm cheering from the sidelines that we don't get this ridiculous speed limiter rule in. I think that's just horrendous. I don't want to see more people killed on the roads. It's crazy as it is. Anyway, I think you're going to see a real pushback on regulations. Remember in the Trump administration, the first one, for every new regulation, we had to get rid of 2. For every new one, we had to get rid of 2. I think you're going to see a rollback of existing regulations and some new ones come in that make more economic sense. But generally, when you think about the Republican administrations, they're very less regulatory focused. So I think I'm looking at a period of deregulation, not ICC level 1980s deregulation, but less regulation. So I think a lot of money in Washington, a lot of lobby groups. I'm not sure the secretary pulls all the strings. Congress has got some pretty heavy lobby groups. Don't forget the rail industry is always there front and center pushing back against us trucking people. Right. So
we're best of friends, but when it comes to what happens in Washington, you're right. We're definitely not friends over there.
We're going to be in for a crazy time. I'd follow the Todd Amon +1 -10 rule, which is do 1 extra load per month and slow down 10 miles an hour. I would focus on cost control like you wouldn't believe in the first part of next year, and try and find new lanes and build new partnerships with brokers if you're in the spot market. Get new contract, solidify your contracts with your existing shippers. I just think this first 6 months is going to be a real testing period for a lot of us until we know where the market's actually going to land. But I think we don't
know which way this thing is going to go. We have no idea. The tariffs may never happen, but they could pass them immediately. Who knows?
Yeah, it's. The market loves volatility, right? There's nothing quite like a boring freight market to drive everyone nuts. But I was hoping we'd have a fairly normal year this year, which we kind of did. It was a pretty flat year, but now we've got more upheaval coming, more strikes, more potential tariffs, more deregulation. There's so much instability in the world. Not just, when you talk about geopolitical risk and countries fighting, it just, these are interesting times to be in the trucking business.
It's funny. A year ago, Dan Ronan from Transport Topics Radio said, watch out for 2024. It's going to be the year of labor unrest. And man, he was right on the money because it has been.
Yeah, Dan knows his stuff. Absolutely. I don't know that we're past that yet. I think January 20 will be, or January 15 with the ILA. That's sort of a pretty big one.
Well, we've got a mail strike in Canada.
I tried to send a package today, and they said we can't send it.
That's right.
Because there's a postal strike in Canada.
Yeah, I know. You're going to have to send it with FedEx, and it's going to cost you a fortune.
I'm kicking myself because I was driving to the post office and I stopped and talked to a friend of mine who just delivered lobsters from Nova Scotia here in Gloucester. And I thought I should have given him the box to take back to Bridgewater.
He could have sent it with a domestic courier.
Hey, lobster season opened in down near Yarmouth last week, and all the big trucks are in town. The big triaxle Canadian trailers, the ones?
Yeah.
Fresh lobster.
Well, it's always, my understanding is that there's a lobster season pretty much all year round, but it goes from area to area.
Yep, starts in PEI, works its way around. So down in Yarmouth, which I think they call it the lobster capital of Canada, or certainly Nova Scotia, all those guys that run to New York and Boston are down here every night. I saw 2 of them today. I saw one of Brian Reynolds' trucks here. They were loading bait fish back. It's bizarre. They'll come down with fresh lobster and then they'll take bait fish back from Gloucester to catch the lobsters with. It's great freight.
That's a good round trip.
Right. Well, Dean, I'm looking at the time and we are pushing right up against it.
All right.
Anything that you would like to leave us with? Any parting shots before we get out of here?
Strap in. I think next year's going to be very, very interesting. It won't be boring. You better make sure you know your operating costs, because brokers are going to be wanting to try and expand their margins when rates go up. So
course.
Stay on your toes.
Sage wisdom.
Yeah.
Well, everybody, Dean, when does you do your newsletter? Comes out every Tuesday as well, right?
Yeah, Tuesday. We publish it Tuesday night at DAT.com. Our IQ show's on. We've got a month of economic forecasters. We've got Jason Miller on next week. It'll be a really good show, 10 a.m. Eastern next week. Catch us on YouTube. So, yep, lots of good stuff happening.
So, guys, make sure that you're locked in with Dean over on all of those different channels as well.
Yeah.
So, with that being said, how can if the people got a question for you in the meantime, Dean, how can they get in contact with you?
Yeah, just Dean.Croke, CROKE at DAT.com. I'm on social media at the Grumpy Pete or on LinkedIn, Dean Croke, DEANCROKE. So I'm active on all of those channels.
There you go.
Thanks for joining us tonight. This was great.
Good stuff. Thank you, guys.
Chuck, how do the good people find you and get a hold of you?
If anybody needs me, just send me an email. Put your phone number on it to chucksnow280@outlook.com, and I'll get back to you as soon as I get the email.
Ladies and gentlemen, we appreciate you guys. We appreciate your attention. Whether you watched us, hung out with us live, or you're watching a rebroadcast, we're always eternally grateful for you doing so. Once again, if you found anything that we discussed tonight entertaining, helpful in any kind of way, please, by all means, give us a like, give us a subscribe. It definitely helps us out. It doesn't cost you anything, and we definitely appreciate it.
Yeah.
And so for my co-host Chuck Snow, and for our special guest for the evening, Mr. Dean Croke of DAT, this is Rico Muhammad of the Racing Lanes Podcast signing off for tonight. God bless you guys. Stay safe out there. Stay healthy. Keep it in between the mustard and the mayonnaise, and we'll talk at the same time, same place next week.
Catch you on the flip-flop. God bless. Thanks, guys.